Rolling.
So welcome back. We're here in Chapter 4, the wild and wacky world of income taxation. And today we're going to go through a typical tax return of Chuck and Diane Taylor. It's contained on pages 114 and 115 of the text, okay? But before we get to that, I just wanted to take a quick look at figure 4.3. It's on page 106, which shows you basically the outline of what a tax return, income tax return is all about, okay? As you take a look at that, the first block basically, the line summarizes gross income. Okay, and gross income basically in the Internal Revenue Code, the Bible of taxation, anything that you receive during the year, okay, is deemed to be income. Okay, whether it's money or it's gold or it's elephants, whatever it is that you happen to receive, basically is deemed to be income unless the book, the Internal Revenue Code, specifically excludes it from income, okay? And some of the most common examples of exclusions from gross income are gifts. You know, I'm sure many of you out there have received gifts in your time, and when you received those gifts, did not file an income tax return, and the reason why you didn't have to is because gifts are excluded from gross income, okay? Gifts, same thing with inheritances, which are gifts upon one's death, same thing, excluded from gross income. So we have a lot of the popular exclusions. As you look through the chapter, you'll see some of the other exclusions from gross income. Most notable would be bond interest that you receive from state and local bonds. They're excluded from gross income. Okay, you might ask why. I mean, bank interest is included, certainly. Even United States Treasury interest is included. Why would state and local government bond interest be excluded? And the answer, very simply, is the fact that when they wanted to levy an income tax, okay, they needed to pass the constitutional amendment. In order to pass a constitutional amendment, you need at least 2/3 of the states to approve it. And so the quid pro quo, so to speak, was we won't tax the interest on your bonds that you issue if you approve for a federal income tax. And so that's why state and local government bond interest is excluded from income. Okay, so those are some of the popular exclusions. Almost everything else is included in gross income. Obviously, there are instances, as we're going to see as we look through the tax return, where you perhaps could defer income tax to a future year. And then there are other instances where even though you have to include it in the current year, you would tax at a reduced rate. We call a tax advantage rate. So as we go through the tax return, we'll take a look at those things. So the first block on figure 4.3 is gross income, and they are outlined on page 114. If you take a look at income on the form 1040, income lines 7 through 21. Lines 7 through 21. We're going to go through them in more detail. As well, let's do that now. Actually, let's slip over to page 114 now. Okay, take a look at a typical tax return, form 1040. Okay, and as we see, once you get through the heading, names, social security numbers of the individuals in the heading, that you basically, and we'll talk about exemptions a little later on. But as you take a look, starting on line 7, you'll take a look at all the different major categories of income that one has during the year. And obviously tax returns are levied on a calendar year, year after year. So line 7, wages, salaries, tips, etc. Obviously that is the money that you have earned as an employee, okay? And instead of you having to keep track of how much you earned as an employee, the employer is required to issue a Form W-2. Many of you, I'm sure, who've had jobs, were employees, have gotten the W-2 issued to you during probably January after the year end. Okay, so this is so you can file your income tax return, which, as you know, is due by April 15th of the year after year end. So getting it by the end of January, which an employer is required to do, gives you plenty of time to file by April 15th. So the W-2 really summarizes the wages that you've earned, and this time, if you made $10 an hour and you work 20 hours, that's $200. 10 times 20 is $200. So you're going to get taxed on your gross wages, not the $147.54 that you received after taxes were reduced and taken out of your pay. Okay, so that's line 7. Line 8 is taxable income, taxable interest income. I should be more specific. Taxable interest. Okay, and that basically is most forms of interest income that you're going to receive on a savings account, right, on a bank account, on most bonds is taxable. We just noted the exception, the exclusion for interest received on a state or local government bond. Okay, so basically, if you have lent money to New York State or New York City and are getting interest on that bond from the state or the city, that will be tax-free interest. Okay, so that would be what is included on line 8A. Line 8A would be the taxable interest. Line 8B would be the tax-free interest. They call it tax-exempt interest, right? And so even though you're not going to be taxed on it, they need to keep track of that. There are many, many complicated tax issues which are beyond the parameters of this course. A reason why the IRS needs to keep track of your tax-exempt interest. But you're only going to pay taxes, as you see, on line 8A, right? Because you see line 8A extends out to the column on the right, and that's the accumulation of taxable income. Okay. Line 9A, ordinary dividends. Okay, so what are dividends? Basically, dividends are income derived from stock holdings. Okay, you hold stock in a corporation. The corporation might, basically, the board of directors of the corporation might declare a dividend. What's that, you might ask? A dividend basically is taking a portion of the corporation's earnings and returning them to the stockholders. Okay, who has the ability to make that decision? The board of directors. Okay, so even though stock is actually ownership in a corporation, okay, the owners don't make management decisions, such as whether or not to return the earnings to its owners. That's up to the board of directors. That's up to management. Okay, and we'll talk much more about that. Oh yes, much more when we get to the chapter on common stock after the midterm. Okay, so those are the dividends, and you put them there on line ordinary dividends on line 9A, and then you see line 9B talks about qualified dividends. Okay, and this is discussed earlier in the chapter. Just to turn back to that portion of the chapter, you'll see that basically on the bottom page 97, when they talk about capital gains and dividend income. Okay, this is our first example of income that has a tax advantaged rate, fully taxable in the year you get it, but it's going to be taxed at a lower rate than your other income, what we call qualified dividends. Okay, so most dividends that you're going to get from a corporation, okay, they aren't going to be taxed, but they're going to be taxed at a reduced rate. This has been a very highly controversial topic, issue. Okay, people on one side of the political spectrum feel that it shouldn't be taxed at all. Okay, and what's the reason it should be taxed at all? Well, when the corporation earns the money, okay, it sells goods, it renders a service, the corporation is taxed. The corporation is a separate taxpayer paying tax on the money it earns. Okay, when it takes part of that earnings and it distributes it to its owners, well, it's being taxed a second time, what we call double taxation. Okay, so people on one side of the political spectrum say that's immoral, that's egregious, that's disgusting, and it shouldn't be taxed at all because it was already taxed. Okay, now people on the other side of the political spectrum say, wait a minute. Okay, dividend income has always been subject to taxation since the Internal Revenue Code was first came into being in 1913. Okay, and let's face it, who gets most of the dividend income? Who has most of the stock holdings in our country? Who derives most of the dividend income in our country? You guessed it, right? That upper 1%, the millionaires and the billionaires. So if you eliminate taxation on dividend income, isn't that a tax break for the rich? You know where I'm going with this, okay? So there was a lot of infighting about that. the compromise that was struck is we will tax it, but we'll tax it at a reduced rate of roughly 1/2 of the normal income tax rate. Okay, so that's why there's a 9B to figure out what your qualified dividends are going to be, because even though that's going to be taxed, it's going to be taxed at a different rate than your other income will be taxed. Okay, as we move down, we take a look at certain other items. Let's move on to line 11. Okay, alimony received. Okay, and what's alimony? Basically, that's support from one spouse to another, or one ex-spouse to another, right, upon a legal separation or divorce. Okay, amounts that are received for spousal maintenance and support are included in the income of the one receiving it. Okay, and conversely, deductible to the one who is paying it. Okay, so if you want to drop down quickly to line 31 on that same page, line 31, alimony paid, you see that it's deductible to the payer, spouse, and you notice that if you take a look at line 31B, the payer spouse, in order to get that deduction, has got to turn in the other spouse, right? They want the social security number of the person who is receiving the alimony. And this is how the government can keep track to make sure that the person receiving the alimony reports it. Because the amount of alimony paid by one ex-spouse has got to be exactly the same as the amount of the alimony received by the other ex-spouse. And if they're not exactly the same, you expect letters from the IRS trying to get to the bottom of it. Okay? So that's alimony, line 12, business income. Okay, now this is not as an employee, right? But as a self-employed individual, right? You have to report your net income from your self-employment. Okay, so very simply, let's say you're selling an item, okay, selling a good. You have to report the fact that you received $100 for selling that good, but you also get to offset the fact that it cost you $20 to buy that good, right? You bought the good, you didn't make it yourself. You bought it from a wholesaler and you sold it to a customer. Okay, so you sold it for $100. It cost you $20. So of course you would have to include $80 of net income. 100 minus 20, $80 of net income on line 12 of your form 1040. Okay, and there's a separate schedule, Schedule C, that you will report both the revenue and the cost of in order to generate that revenue. So it looks like pretty much remember the personal income statement from Chapter 2 that we did looks pretty much like that, except all expenses that are recorded must relate to the generation of income in your self-employed business. So that's for self-employed individuals. Business income on line 12. Line 13 talks about capital gain or losses, okay? Now this mostly derives from selling investment property, okay? So when you have investment property, this is interesting, okay? When you have investment property, okay, and you bought it, let's say a stock, or real estate, or a bond, or something like that, right? And you basically hold on to it, right? You don't sell it year after year after year, and let's say the value increases on that investment year after year after year. You don't pay taxes on that, okay, until the year you sell it. Okay, so in that way, you see that's a form of tax deferral, right? Because you're deferring the taxes until you sell. You can actually pick and choose the year you recognize the gain, right, and the year that you sell it. And a lot of tax planning involves just that, making the decision as to what year you want to recognize the gain, depending on what other income you've got, depending on what your tax rate is for that year versus what it might be for the next year. So that's what we call tax planning, a lot of what a personal financial planner does. Okay, so the capital gain or loss, and you can have a loss too, right? Because you buy, let's say, Google stock for one price, right? And then you'll sell it for another price. No guarantee that the price you sell Google at is going to be more than the price you bought it at, right? We talked about that in Chapter 2 when we differentiated between investment assets and monetary assets. We said investment assets, you expect to perform much better than monetary assets. In other words, the rate of increase over the long term should be much larger, but it's riskier in that investment can go down in value. Whereas in monetary assets, we have 99.9% certainty that the investment will not go down. And it won't go up much, but it won't go down at all. Okay, so you can have a loss as well as a gain. Okay, and this line 13 is where you would record the gain or the loss, depending on the difference between the selling price and its original cost. Yes, yes. Now, here's another thing about capital gains or losses, kind of interesting, right? Is that if you held the investment for more than 1 year before you sold it, okay, this is what's called a long-term capital gain. Long-term capital gain, okay? And here's another example of selling an asset, reporting the gain at a tax-advantaged rate, okay? It's the same rate as dividend income. As a matter of fact, if you go back to page 97, you're going to see that at the bottom of page 97 it says capital gains and dividend income, okay? Capital gains are talking about long-term capital gains, okay? Capital gain. So they don't want to encourage you wheeling and dealing, trading stocks. Okay, basically treating it like gambling. Okay, so to speak, speculating is what they call it. We'll talk a lot more about the difference between speculating and investing again when we get to our discussion of investments after the midterm. Okay, but they don't want to encourage that, so they don't give you a special tax rate. But if you hold it long term, more than a year before you sell it, they will give you that tax advantage rate, just as they did for the qualified dividends. Okay, so you're seeing how investing, right? There are a lot of tax incentives for Americans to invest. Dividends are taxed at a lower rate. Capital gains are taxed when you decide to sell it, and if you decide to hold it for more than a year, you're going to get that same wonderful tax advantage rate. Also, I want to point out, and this is over on page, let's see, bottom page 98, okay? Your home, your personal residence, your primary personal residence is what we call a capital asset, okay? And if you sell it after all the years you lived in it, where basically you spend all your time, where your spouse sleeps and your children play with their toys, at that point in time, you may have a large gain because you probably held it for decades, right? We all know about inflation, time value of money, right? That it costs more and more money to buy the same thing. So certainly, if you held your principal residence for 30 years, you would expect that in dollar terms, you're going to get a lot more dollars when you sell it than you had to pay for it, okay? And generally, that's true, okay? So to sort of cushion that blow, okay, there is a tax exclusion, a very generous tax exclusion afforded by the code of up to $250,000 of gain. Okay, not sales price, but the gain, the difference between selling price and what you originally bought it for, right? An exclusion of up to $250,000 of gain if you're single, and if you're married, filing jointly, right? If a married couple is filing the tax return together, just as Chuck and Diane Taylor are here, then you have an exclusion of up to $500,000 of gain. $500,000 of gain, a very generous exclusion, and all you had to do was use the premises as your principal residence, right, your primary residence, for 2 of the 5 years prior to the sale. So they even allow you a period of time where maybe you're having a little trouble selling it, you did move out to a retirement home in Florida, and maybe for a couple of years, and then sold it. Okay, so all you have to prove is that you use it as your primary residence for 2 of the 5 years prior to the sale date. So that's a very generous tax exclusion. So we're seeing that in the wild and wonderful world of capital gains, right? We have the opportunity for tax deferral, we have the opportunity for tax advantage rates, and we have an opportunity when it comes to the primary residence of out-and-out tax exclusion. Right? So something to bear in mind. Okay. Obviously, here's a way that we want to encourage the American dream of home ownership, right, in that situation. Okay, so we move on to other gains and losses. That's basically business property. If you're in your own business and you sell a piece of business property, that would be a gain or a loss. It's not a capital gain. Capital gains and losses are generally investment type property, not business property. And then we go down to IRA distributions, pension and annuities, lines 15 and 16, okay? These are retirement plan assets, okay? We always said that there's a huge tax deferral, right, when you put money in a retirement plan. Talked about that back in chapter 2, okay? We're going to talk about it again when we get to the retirement plan chapter towards the end of the course, okay? But remember that we do pay taxes eventually, right? When do you pay the tax? When you take it out of the plan, right? So these are the lines you would report the distributions from the IRA, from the pension, when you take it out of the plan. And this is why I have 70-year-olds, 80-year-olds, 90-year-olds shuffling into my office to get their tax returns done because of constantly getting these retirement plan distributions, and as they get them, they have to pay taxes on them, okay? And so that's what you're looking at there, okay? Rents and royalty income, if you have a piece of real estate that you're not living in, but you're renting out, okay? Once again, we're gonna have like an income statement showing the rental income you earn, less whatever expenses relate to the rental income, whether it's interest, mortgage interest, or it's real estate taxes, or it's homeowners insurance, maintenance, repairs, all those types of things during the year. So that you're going to report the net income from your rental property on that line. If you happen to be a member of a partnership, you're going to also report your part of the partnership income on that line, things of that nature. Farm income, self-explanatory. Unemployment compensation, yes, indeed. If you receive unemployment compensation because you got laid off, that is fully taxable, and it's going to have to report that on that line 19, okay? Social Security benefits, that's a very complicated situation, okay? Now the thing is, and this is going to be a little bit of a hint for the homework problem we're going to be working on, the assignment we're going to be working on. One thing that you should know is that if you're living on Social Security and you have no other income, okay, Social Security benefits will be non-taxable. They'll be tax excluded, okay? But if you're getting Social Security benefits, remember that's a right. Every individual who paid into the system has a right to get Social Security benefits regardless of their other income, okay? But if you have significant other income, substantial other income, part of your Social Security benefit starts to become taxable, starts to become included, okay? This is what we call a phase-in, okay? And if you have significant, substantial other income, the benefit that can be included can be as high as 85% of the benefits received for the year, okay? So it can be subject to taxation if you have a lot of other income, okay? And this is not a tax course, so we're not going to get into that very complicated calculation. But just be aware of the fact that Social Security benefits will only be taxable if you have a lot of other income, interest, dividends, wages, self-employment income, things of that nature. Okay? All right, other income on line 21, boy, that could be, basically hitting the lotto would be a good example of the other income, And here's a good question. Is illegal income taxable? Okay, think about that, okay? And basically, for those of you who answered no, come on, get real. Obviously, the government's not going to say, okay, if you make income illegally, you don't have to pay taxes on it. I mean, that doesn't make sense, does it? So in fact, that is how they get a lot of mobsters, basically, to, when they can't prove anything else, they'll say, basically, well, how did you afford to live? You must have made $1 million this year in order to live the lifestyle you're living with, limousines and great big houses and everything else. And so the tax law is the only area of the law where the burden of proof is on the accused. Okay, so the government says, hey, listen, you prove how you lived without earning $1 million based on your lifestyle. Well, this is how they can basically lock up people who are, in the mob and organized crime and things of that nature. So other income certainly is something that you should be aware of, certainly. So if we go back to figure 4.3 on page 106, okay, and we look at step 2, step 3, and step 4, okay, we notice that all those 3 steps relate to tax deductions, okay. The amounts we're going to take off our income in order to get to taxable income, which is what we base our tax on, okay. So 3 categories of deductions. So obviously they're all going to be treated differently. Okay, so step 2, what they call calculating adjusted gross income, what they call adjustments, is basically summarized on the tax return on page 114 lines 23 to 35. 23 to 35, and those are the first category of adjustments. Now, most of these deductions relate to business, employment, or investment. Okay, they're not personal type of deductions. Okay, now the Internal Revenue Code tells you, okay, in a specific section that nothing you spend money on is tax deductible, unless this book says it is. Okay, the exact opposite. So with income, right? In income, everything is income, unless the book says it isn't. When it comes to money you spend, nothing is tax deductible unless the book says it is. Ooh, yes. Okay. So, taking a look at adjustments on lines 23 to 35, see a lot of different types. First, on line 23, educator expenses. Okay. And that's a very limited expense of $250 a year for people who are educators. Am I an educator? No, I'm not. Okay, because educator is defined as a teacher from kindergarten through 12th grade. As a college professor, I am not deemed to be an educator. I guess that's why they don't call me a teacher. So taking a look further down, we'll be looking at some other line 25 health savings account deduction. We'll take a look at that when we look at the different ways, different health care programs. We look at health insurance. We'll see what that's about. Moving expenses, that relates to a move that is business related, okay, where you're moving because you changed jobs and you're living much further away from your new job than your old job, so you had to move. So that's also businessy related. Something called self-employment tax, deductible part of self-employment tax. We'll see how that works. Remember, when you're an employee, your employer takes away that Social Security tax as part of tax deductions. When you're self-employed, you don't have an employer to take it away, so you have to take away the Social Security tax from yourself, so to speak. Okay, and basically you have to take away twice what an employee would take away, because an employer matches whatever they take out of the employee's pay. The employer has to match it. So when you're self-employed, you're the employer and the employee. You take away double, and so that's why they let you deduct half of the self-employment tax that you paid. That's what that's about. Then you have, of course, your retirement plans. Get deduction for amounts you contribute to your retirement plans, and whether it's a self-employed plan on line 28 or an IRA on line 32. We'll learn much more about that when we talk about retirement plans in the future. What else? Alimony paid, we talked about. Student loan interest, that's something of particular interest to many of you out there. You do get a deduction for student loan interest. It's limited to $2,500 a year. And that is our first example of what we call a phase out. Okay, so some deductions that are only allowed if your income isn't over a certain amount. Once your income is too large, okay, they start to take away the deduction. They start to phase it out. Okay, it's the opposite of the phase in we talked about with Social Security benefits, right? If you have too much other income, it starts to include your income. Here, if you have too much income, they start to take away your tax deduction for student loan interest. Tuition and fees deduction on line 34. Okay, that's also a deduction that is given to you for tuition, college tuition. Okay, maximum of $4,000 per year. But again, once again, that starts to phase out. And if your income is over a certain threshold, then the limit becomes $2,000. And then if your income is over a second threshold, $0. So again, tuition fee deduction is allowable only if you don't have significant other income in that situation. Okay, but that's again a student loan interest, tuition and fees. Two other examples of how the government tries to subsidize higher education. Okay, that only relate to college costs. Okay, so once you add all those up over on line 36, okay, you deduct it from total income on line 22, and that gives you a very important number. It's called adjusted gross income. It's so important. It's the last line of the first page of the Form 1040 on line 37. And then it's also, as you'd switch to page 115, the first number on line 38 of the second page of the Form 1040. This adjusted gross income number, that's the number they usually look at to see whether or not we need to phase out a deduction or phase in income. So the adjusted gross income is generally the number that they look at. Again, thresholds, depending on what you're looking at, the threshold is different for Social Security benefit inclusion than it is for the student loan interest or the tuition and fee deduction phase out. It's different for everything, and again, a little bit beyond the parameters of our course to really get involved in the specific numbers. If you're so interested in the specific numbers, I would advise you to take the income tax course in the accounting program. Okay, so we have the adjusted gross income at that point, and then we go to what we call step 3 over on page 106. And step 3 talks about the greater of itemized deduction or standard deduction. Okay, and so what we should know is that basically it's an alternative deduction, right? You pick whatever you want as the taxpayer. Okay, the standard deduction is very easy. Okay, look at the bottom of page 104, figure 4.2. This is the standard deduction that each individual is entitled to, depending on whether you're filing single, okay, whether you're a married couple filing jointly, okay, and basically married means that on the last day of the tax year, December 31, what's your status? Are you married or are you unmarried? Okay, if you're married, then you have two choices. Married filing jointly, where both spouses file together for the whole tax year, as if they were married for the whole tax year, or married filing separately, okay, basically, which basically there is a typo in the text. If you look at the bottom page, figure 4.2, that last should say married filing separately, not married filing jointly. Okay, so then make that correction in your text. Married filing jointly, obviously, double the standard deduction of a single person because there are two people involved, right? So there you go. The last filing status you could have is head of household. Head of household, you're not married, okay, but you're not exactly single, if you know what I mean. In other words, you're caring for a dependent relative. Generally, you have a child, or you have a parent who is dependent on you financially. We'll talk more about dependence when we get to the next category of deductions. Okay, so that's standard deduction. I mean, basically, the government's begging you, just take it. We're giving you $6,200 if you're single for 2014, somewhat higher now. We're giving you $12,400 of deductions if you're married. We figure, basically that much of a deduction we'd like you to have for your personal expenditures. Okay? Or you can take what's behind door number 2. Okay? And how do you figure out what we call itemized deductions? Okay? Basically, if you take a look at page 116, Schedule A summarizes the categories of deductions allowed by the Internal Revenue Code, okay, that are not strictly businessy type deductions, okay, but are more in the personal realm. Right. So you see the categories, Schedule A on the left-hand side, left column, medical and dental expenses, taxes you paid, interest you paid, gifts to charity, casualty and theft losses, job expenses and certain miscellaneous deductions, and then total. Okay. Each of those categories dealt with separately. Medical and dental expenses basically are those items that you spend for, obviously, doctor bills, dentists, health insurance, a lot of other types of expenses related to medically necessary situations, okay? Which means that if it's plastic surgery you're after, it's not deductible, okay? Drugs are deductible if they are prescribed by a physician. That means Tylenol, not deductible. Right? That's prescribed by a physician in order to be deductible. health insurance premiums, deductible. Okay. Obviously, if expenses that you incur are covered by insurance, you can't deduct them because you're getting reimbursed for them, right? So you add all those medical and dental expenses together, you add them all up, right? On line 1, okay? And then on line 2, they're telling you to enter the amount from Form 1040, line 38. Which if you look at Form 1040, line 38, back on page 115, is your adjusted gross income, okay? Then they ask you to take 10% on line 3, 10% of the adjusted gross income, and then reduce your total medical and dental expenses by that number. This is another example of a phase out of a deduction. Okay? And so, most of my clients, if a client has $100,000 of adjusted gross income, right, and they got $5,000 of medical and dental expenses, what's going to be the deduction on line 4 of Schedule A? The deduction is going to be 0. Okay? Because $100,000 times 10% is $10,000. Right? So if your total expenses are $5,000 and you have to reduce it by $10,000, well, obviously there's nothing left. Okay? So most individuals, unless they have really catastrophic medical expenses for the year, are not going to get a deduction for their medical and dental expenses due to the very large phase out. Phase out. Same thing applies, by the way, for casualty and theft losses. Okay. First of all, you got to prove that you had the casualty or you had the theft. Not an easy thing to do. And then they take away 10% of your AGI there too. So you'll see most people don't have a casualty and theft loss deduction. Those two categories are rare. Okay. Unless you have, again, prodigious medical and dental expenses or a catastrophic casualty to your property. Taxes you paid are very common, okay, to take, especially in New York State and New York City, okay? Because you see on line 5, Schedule A, first category, state, local income taxes, okay? Since we are very heavily taxed here in New York State, New York City, it's our honor to fund for both the state and the city here in Brooklyn, USA, okay? A very significant amount of money is taken away from your paycheck, right, by your employer to remit to New York State and New York City, right? So because that amount is taken away is significant, you do get a tax deduction on your federal tax return for those amounts that were paid to New York State and New York City. You put it on line 5, and there's no phase out for that, by the way, okay? Line 6, if you own a home and you have real estate taxes to pay, yes, line 6 is where you would deduct that as well. So those are our large deductions if you're a homeowner, New York State, New York City resident. But generally, line 9 total tax will be significant. But remember, you're going to compare the total to that 6,200 if you're single, right? So you're going to take the better of the two numbers. You can't add them together. I got you. No, you're going to take the larger of the two numbers. Can't do that. Okay, interest paid. The biggest item of interest you might have is if you own a home, the interest on your home mortgage. That might be something you can take. Line 14 says investment interest. If you borrowed money to buy investments, stocks, bonds, mutual funds, things like that, the interest on your investment might be deductible to the extent you have investment income. Okay, so your investment interest can never be more than your investment income, dividends, and interest from those investments. What you see conspicuously missing from interest you paid, right? Credit card interest, right? Your personal interest is not tax deductible. You're on your own for your spending spree. Okay, government's not going to subsidize the interest you pay for personal items. Okay, so there you go. So you notice between the real estate tax and the home mortgage interest, the government once again is trying to subsidize the American dream of home ownership. They're giving you a tax deduction. How much tax deduction do you get for your rent? That's right, 0. So there you go with that. Okay, is that fair? Well, who said life was fair, right? Okay, so we get on to the next category, gifts to charity. Here the government tries once again to encourage you to be philanthropic, to give to charities. Okay, now to give $10 a week, okay, to a homeless person on the street, you're more charitable than you think you are because you're not going to get a tax deduction for that. Okay, the charitable organization has got to be qualified with the IRS for you to get a tax deduction. Okay, and those are the only ones you can give money to and deduct the amounts that you've given. Okay, so there you go. And if you give more than $250 to one charity, $250 or more to one charity, you've got to get a letter from the charity proving that you made that contribution for the year. So you've got that. Again, no limitations on the gifts to charities. There is a ceiling if you give an exorbitant amount, over half your income to a charity in 1 year. But most people don't run afoul of that ceiling. And then you've got other expenses, jobs and miscellaneous deductions, tax preparation fees, unreimbursed employee expenses, things of that nature. Okay, those expenses are subject to a phase out, just like the medical and dental expenses were. Although the phase out amount is not 10% of your adjusted gross income, it's only 2% of your adjusted gross income. Okay, but you see for the tailors, if you take a look at line 24 and 24, 25, 26, and 27, again they got zero. And once the phase out took hold. Okay, so you add up all the deductions, itemized deductions after any applicable phase out, add them together. Okay, see whether or not that number exceeds the standard deduction. Take the larger of the two numbers. Okay, in step 3. Okay, so step 2, when we talked about the adjustments, okay, they were all tax deductible because there is no alternative. Okay, but in step 3, the itemized deductions, which you put on line 40, by the way, on page 115, you don't necessarily take the itemized deductions. You only take them if they exceed your standard deduction. Okay, standard deductions, by the way, you don't have to prove, right? Itemized deductions, you do have to prove, right? So another reason why you might want to take a standard deduction. Why does the IRS do this with the standard deduction? Why do they encourage you to take it? Because they feel that people cheat. They make up numbers for their itemized deductions, and they hope to get away with it by not getting called by the government in a tax audit. Okay, so they want you to take the standard deduction and discourage tax cheating. Okay, so that's the second category of deduction. The third category is on line 42, exemptions. What do we mean by exemptions? Okay, well, go back to the first page on Form 1040 in the heading area before line 7. You see line 6, exemptions. Okay, and you notice that the first one on line 6A, yourself. You get an exemption just for being you. Okay, and the exemption amount basically back in 2014 was $3,900. You see that in line 42. Now it's well in excess of $4,000. Okay, so we're going to give you another deduction just for being you. If you happen to be married filing jointly, you'll get another one for the spouse. Okay, so there's 2 right off the bat. And then they give you a deduction, an exemption, for each dependent that you have. Okay? How does one qualify as a dependent? Well, if we turn back into the chapter, we see that there is a 4-step calculation of when one might qualify as a dependent over on page 105. Okay, step 4, claiming your exemptions. Okay, you see the 4 green diamonds. Okay, one has to pass all 4 tests in order to qualify as a dependent. If one qualifies as your dependent, you get an extra exemption for each dependent. Okay, okay. So let's take a look at the 4 diamonds. 1 is the relationship test. Okay, one has to be significantly closely related to you. To qualify, generally think of children, right? Parents, siblings, nieces and nephews, aunts and uncles, right? Grandchildren, grandparents, all could qualify in the relationship test. Okay, no cousins, man. Cousins do not qualify in the relationship test. However, anybody, your neighbor, could qualify under the relationship test as long as they lived with you for the entire tax year. So it's either somebody who's closely related to you, who may or may not live with you, or it's anyone who lives with you for the entire tax year. Okay. Secondly, you have the income test. Okay. The income test basically means that you can't earn as much or more than the exemption deduction amount, okay? So if it's $3,900, you can't have earned income of $3,900 for the year, okay? The one huge exception to the income test, by the way, is children, 19 years of age or younger, okay? And if the child goes to college full-time for at least 5 months, then it's children age 24 or younger. They can make as much money as they want, but if you satisfy the other 3 tests, you can still take them as your dependent, okay? Another thing, and this is going to have to do with our assignment, okay? Income only means income subject to tax, okay? So tax-exempt income would not count in this prong of the test, okay? So just to be clear, okay, you can have a teenage I don't know who the latest teenage prodigy is out there, okay, who's under 19 but making millions of dollars, basically singing his or her little heart out, okay? But if they take all that money and, you know, basically that would not disqualify them from being a dependent on their parents' tax return, as long as you satisfy the other 3 prongs of the test. Obviously, you satisfy the relationship test if you have a child, all right, of your parent, okay? The third test, and this is the biggie, okay, is that you provide more than half of the dependent's support, financial support, okay? So if that child prodigy making millions of dollars puts all their money in the bank, right, and the parent, right, supports the child during the year, right, food, shelter, clothing, medical care, recreation, right, as long as they supply more than half of the support for that child during the year, then they satisfy the support prong, okay? And that's when it's the most important, most controversial. Do you supply more than half of that person's support for the year? Lastly is the citizenship test, okay? To be a dependent, you have to be a U.S. citizen, resident, or a resident of either Mexico or Canada, okay? So if somebody lives over in Hungary, okay, but you support them totally, they don't have any income, they happen to be a parent, if they're a citizen resident of Hungary, you can't take them on a U.S. tax return. That's the dependent. Okay. So those are the 4 tests. You got to pass them all. If you do, you're going to get that exemption of approximately $4,000 for each person. So that could add up to quite a significant sum. As you see for the tails on line 42, it added up to $15,600. Right? The tailors, the spouses, plus the 2 children, Kathleen and Lindsay Taylor. So there you have the 3rd category of deduction. Okay, that will yield you line 43, taxable income, and this is the item, okay, that you're going to calculate your tax on in accordance with the tax rate tables over on page 95. Okay, and basically you will calculate your income tax based on that number. Okay, remember, progressive tax rate system. The more on a stair-step pattern, the higher income, the higher you will be taxed on your excess income over that threshold amount. That tells you what your tax is at that point in time, and then after calculating your tax, we're going to be discussing tax credits and why tax credits are even more valuable than tax deductions, because tax deductions only reduce taxable income. Tax credits reduce the actual taxes